Well, Cummins India is trading under pressure after reporting their Q1 numbers. Revenue growth was driven by a strong domestic and pre-buy demand, but export revenue was nearly flat sequentially. The company in their call has stated that they can achieve double-digit growth for FY24. Mr. Ram, who is the Managing Director at Cummins India, joins in now to discuss the performance. Hi, sir. Thank you very much for joining in. So when you mean double-digit growth, can you quantify that for us? What are we expecting when it comes to double-digit growth in FY24? And I assume it's going to be led by the domestic business.
Yeah. So when we mean double-digit growth, we have been speaking about this for the last 3 years. We are talking about growing our business at least 2x of the GDP. So if the GDP is growing at about 6%, we think we should be able to beat 12% as far as growth is concerned. We've been doing that for the last 2 years, and we are pretty confident that we'll be able to do that going forward.
So 2x GDP is what you're confident of. Just a word on your exports business, because that's something that has, worried the street a little more. Because the last time you joined us, you said that for the year, you could see export growth at mid-single digit. For the quarter, it's just about 3% higher. Do you expect it to improve going forward, hold on to that guidance? Because then the ask for the remainder of the year increases. The 500 crore per quarter run rate, does it sustain? How much does it grow to, if at all?
Well, we are trying to sustain that growth rate. So if you look at the numbers historically, what we did in the last couple of quarters is at historical high levels. And we are seeing from that peak, we are seeing some level of softening in markets in Europe, Latin America, and in Southeast Asia as well. Also, some of the work that we do with China, we are seeing a little bit of slowdown there as well. What we are trying to do, though, is trying to see, can we compensate for that softness in market by pushing out more product, being more aggressive in the market, and at least maintain the levels where we are at. So far, we've been pretty successful at doing that, and our attempt moving forward is going to try to ensure that at least the level we have achieved, we maintain that, and then as the markets start to build up again and we launch more products, we start building up on that again.
So what's your guidance or expectation of export growth this year versus the mid-single digits that you had guided for earlier?
I think I'm still, at this stage, with the clarity I have, I'm still guiding that we'll be able to maintain that.
Okay. All right. For the export business, maintain what? What would the growth guidance be?
Maintain the mid-single digit level of growth as compared to the previous year.
All right, got that. The stock, I'm sure you understand that the stock is under pressure because there is a lot of operational weakness that we're seeing, right? The margins are below what the street was estimating. And there's also a sharp 160 basis points quarter-on-quarter decline that we've seen in margins. Now, I understand that there was higher salary and OPEX expenses this time around, but I just want to know, are you facing disproportionate pressure on your margins this year because of all the challenges that we're seeing? And what would the margin trajectory look like in the next couple of quarters?
So, if you look at the numbers and you compare with the previous year, we are actually improved the margins. When you compare with the previous quarter, and the previous quarter was the best ever we had in history, relative to that, it's weaker performance because we had many one-time exceptional items which typically are there in Q4, where we received some cross charges back, etc. And in this quarter, we also moved forward our wages by 1 quarter. This will get adjusted in the running 12-month kind of cycle. So overall, I don't see, if you look at the 5-year trend, our overall labor cost and our SAR is at the same level or below the level we were even a few years ago. And we are continuing to get leverage out of growth in sales. There's a lot of focus within our organization on costs. So I'm not really worried that this is something, one should feel concerned about.
Okay. Mr. Ram, just circling back and talking about the revenue picture, the domestic business is really what has fired up growth this time for you all. What are the trends that you're seeing in the domestic market? What is the kind of order book that you're executing? And what are you guiding for?
Right. So our business is very highly dependent on pretty much the growth of the GDP. And as India tries to grow from being a $3.5 trillion economy to become a $6 trillion economy and then later become a $10 trillion economy, India needs to spend a whole bunch of money on building infrastructure, on shoring up its power generation, on making sure telecom is better. Every aspect of the economy needs to get shored up. And Cummins products are sold in every part of that economy. And so we remain quite bullish about the long-term future of India and also our opportunity
can you give us some
grow
numbers?
within this. So
Can you give us some numbers on what we can expect in terms of growth in FY24? What is the order book that you're executing?
We
What
are
is the
guiding to grow better than 2x of GDP. So which means if GDP is 6%, we will grow better than 12%.
Right. You spoke about power gens, and that is where a fair amount of confusion is, because you did see a fair amount of pre-buying, but now what has happened is that, the transition date itself has been postponed to June 30th, 2024. You were ready with the new product. The old product is selling. You have to maintain the inventory of both of them. How should one look at this as, an impact on your overall business going forward? Because this is a substantial chunk of your revenues.
So there is no real impact as such other than a loss of opportunity to improve margins even further with the launch of new technology and the opportunity to gain some share because of differential products that we are launching. That being said, we were doing well in CPCB2 as well, as you can see from the results just for the last few quarters and for the few years. So we continue to produce those products. And because we were expecting a complete transition to CPCB4, we had also guided volumes lower based on different product and different more expensive kind of product. So we should be able to get some kind of correction from selling the existing product. Also, there are many markets within India which will transition to CPCB4 Plus right away. So markets like the NCR region, there are some states like Maharashtra, Tamil Nadu, etc., where the regulatory authorities have already been issuing notices to all users of CPCB2 product to say either you fit retrofit emission control devices or you move to CPCB4 Plus. So we think those markets will also start using CPCB4 Plus product. In summary, what I'm trying to say here is that while it's not a 1-0 transition, it's not a 100% transition, it's a mixed transition, which means both products will continue to exist for the next 12 months. And actually, the opportunities for the company do not reduce. The opportunities to actually sell more actually increase.
Got it. Got it. All right. We'll let you go on that note. Thanks a lot for joining in. That's Cummins. The stock is under pressure after a weak set of margins, but the company says that demand is not too bad, although some of the export markets are seeing softening of demand. By the way, Devyani International is under pressure after reporting a weakness in margins. Margins have come in at 20% versus about 22% same time last year, and the stock is now down almost about 2% or so. Sudden knock for the worst. We'll do one thing. We'll take a quick